What was your biggest takeaway from today's earnings?
Well, compared to the middle of March, it's really a sigh of relief that our largest banks are durable. They were able to outperform. And also looking ahead, we're still seeing a healthy consumer, and there's a lot of commercial loan activity. So overall for the banks, particularly the largest banks, it looks like an opportunity to gain wallet share and for investors to have higher confidence on return of capital, whether it be dividends or for share buybacks.
It's good to see you, Ken. So on the JP Morgan Chase earnings call this morning, Jamie Dimon was asked about the impact of Silicon Valley Bank collapsing. Let's listen.
Yeah, I wouldn't use the word credit crunch if I were you. Obviously, there's going to be a little bit of tightening. And most of that will be around certain real estate things. You've heard it from, real estate investors already. So, I just look at that as a kind of a thumb on the scale. It just makes the financial conditions be a little bit tighter. It increases the odds of a recession. That's what that is. It's not like a credit crunch.
So it's not a credit crunch. How would you describe the impact of the SVB collapse as we move forward?
It's opportunity and risk. For the largest banks, it's an opportunity to gain share. Where there's risk is for the smaller regionals or community banks that really depend on commercial loans, particularly commercial real estate. This is not a significant percentage of loans for a JP Morgan or a Citi. Wells Fargo actually gave quite a bit of detail out of their total loan book of $933 billion. Commercial real estate's about $33 billion, and office buildings, which is really where there could be distress looking out 1 to 3 years, is under $15 billion. So I think it's framed right, and Jamie Dimon's comments are correct, mostly because they're sitting there as a global bank.